Let me start with a story that will break your heart and then make you angry. A young couple in Ohio bought a small life insurance policy for their newborn daughter. It cost them $9 a month for $20,000 of coverage. They paid it faithfully, never missing a payment. When their daughter was 6 years old, she was diagnosed with a rare form of leukemia. She fought for 2 years and then passed away. The insurance company paid the $20,000. That money helped cover the funeral and gave the parents a small cushion to take time off work. They felt grateful. But here is the number that haunts them. If they had invested that $9 a month in a simple savings account instead, they would have had less than $300 at the time of her death. The insurance was a blessing. Now, let me tell you another story. A different couple bought a life insurance policy for their healthy 10-year-old son. They paid $15 a month for $50,000 of coverage. Their son is now 35 years old, healthy, with his own family. He has outlived the policy. The couple paid over $4,000 in premiums over 20 years and got nothing back. They could have invested that money and had over $10,000 for his college education or their own retirement. They regret it deeply. Which couple was right? The answer is not simple. It is a tug of war between emotion and logic. And by the end of this video, you will know exactly how to decide for your own family. Let me start with the emotional argument. The emotional side says that no parent should ever have to plan for their child's funeral. But the reality is that child mortality, while rare, is not zero. According to the CDC, about 10,000 children between the ages of 1 and 14 die each year in the United States. That is 10,000 families who face funeral costs, medical bills, and time off work. A small life insurance policy can cover those expenses. It can also lock in insurability. If your child develops a serious health condition later in life, a policy bought in childhood guarantees that they will have coverage as an adult, regardless of their health. That is a powerful benefit. Now here is the logical argument. The logical side says that life insurance is for income replacement. A child does not earn income, therefore a child does not need life insurance. The money spent on premiums could be invested in a 529 college savings plan or a custodial brokerage account. Over 18 years, that money would grow significantly. A $30 monthly premium invested at 7% would become over $12,000 by the time the child turns 18. That money could be used for college, a first car, or a down payment on a house. That is real wealth. The odds of a child dying are extremely low. The odds of a child needing money for college are extremely high. From a purely financial perspective, investing the premiums is a better bet. So who is right? Both sides have valid points. The answer depends on your financial situation, your emotional tolerance, and your goals. Let me break down the 3 specific scenarios where buying life insurance for a child makes logical sense. Scenario 1. Your child has a health condition that could make them uninsurable as an adult. Conditions like type 1 diabetes, congenital heart defects, or cancer. If you buy a permanent policy now, you lock in coverage for life. No future medical exam, no higher rates. That is valuable. Scenario 2. You have a family history of a genetic disease that could affect insurability. If there is a strong history of early heart disease or cancer, buying a policy for your child can guarantee coverage before any symptoms appear. Scenario 3. You have already maxed out all other savings and investment accounts. You have a fully funded emergency fund, a maxed out 529, and a healthy retirement account. You have disposable income and want to provide a small legacy for your child. In that case, a small whole life policy can be a reasonable addition to your financial plan. Now let me talk about the emotional scenarios where buying life insurance for a child might not make sense but still feels right. If you would sleep better knowing that funeral costs are covered, that is a valid reason. The cost of a child's funeral can be $5,000 to $15,000. A small term or whole life policy can cover that. The peace of mind may be worth the small premium. But be honest with yourself. Are you buying because of fear or because of a real need? What about the products available? There are two main types of life insurance for children: term life and whole life. Term life for children is very cheap. A 10-year term policy for $50,000 might cost $5 to $10 per month, but it expires. Your child will be an adult with no coverage. Whole life for children is more expensive, but it builds cash value and lasts forever. A $50,000 whole life policy for a newborn might cost $20 to $40 per month. The cash value grows slowly. By age 18, the cash value might be $5,000 to $10,000. That money can be used for college or a down payment. But the returns are lower than what you would get from investing the same money in a low-cost index fund. Now, here is the pattern interrupt that most insurance agents will never tell you. Many whole life policies for children are sold as college savings plans. The agent will show you a glossy illustration showing the cash value growing tax-deferred. But the fees are high. The early year commissions are steep, and the returns are historically 3 to 4% compared to 7 to 10% for the stock market. If you want to save for college, use a 529 plan. If you want to save for a down payment, use a custodial brokerage account. Whole life insurance is a terrible investment. The only reason to buy it is for the permanent death benefit, not for the cash value. So what should you actually do? Here is your step-by-step decision guide. Step 1. Ask yourself why you are considering this. If it is to cover funeral costs, a small term policy or a small whole life policy can make sense. And $20,000 is usually enough. The cost will be very low. If you can afford it without sacrificing other financial goals, go ahead. Step 2. If you are considering a whole life policy as an investment, stop. Open a 529 plan or a custodial brokerage account instead. You will get better returns and more flexibility. Step 3. If your child has a health condition that could affect future insurability, buy a permanent policy now. It is a small price for lifetime peace of mind. Step 4. If you have disposable income and want to leave a legacy, consider a small whole life policy as part of a diversified plan. But do not make it your primary savings vehicle. Now let me address the UK and Canada. In the UK, child life insurance is often sold as family protection plans. The same principles apply. Term is cheap, whole is expensive. The best alternative is a junior ISA, which is a tax-advantaged savings account for children. In Canada, child life insurance is also available. The alternative is a Registered Education Savings Plan, or RESP, which offers government matching. The logic is the same. Invest first. Insure only if you have a specific reason. Let me give you a real-world example of the right way to do it. A family in California had 2 healthy children. They had maxed out their retirement accounts and had a healthy emergency fund. They bought a small $25,000 whole life policy for each child at a cost of $15 per month per child. The policies were from a mutual company with good dividends. By the time the children were adults, the cash value was modest, but the death benefit had grown. The parents viewed it as a small gift. They still contributed to 529 plans separately. That was a reasonable decision. Now let me give you an example of the wrong way. A single mother on a tight budget bought a $50,000 whole life policy for her 6-year-old son at $40 per month. She could barely afford it. She skipped contributing to her own retirement and had no emergency fund. Her son is now 25 and healthy. She paid over $9,000 in premiums. The cash value is about $5,000. She would have been far better off putting that money into a savings account or her own Roth IRA. That was a mistake. Let me also address the common sales tactic of pay for 10 years and then the policy pays for itself. That is rarely true. Most policies require premiums for life, or the cash value is insufficient to cover the premiums. Ask for an illustration. Read the fine print. Now here is a hidden benefit that agents do not talk about. The guaranteed insurability rider. Some child life policies allow the child to purchase additional coverage as an adult without a medical exam. That can be valuable if the child develops a health condition. Ask about this rider before you buy. Let me recap the key takeaways. Number 1, life insurance for children is rarely a financial necessity. Children do not have income to replace. Number 2, the emotional need to cover funeral costs is real. A small term or whole life policy of $20,000 to $50,000 can provide peace of mind at low cost. Number 3, whole life insurance is a terrible investment. If your goal is saving for college or a down payment, use a 529 plan or a brokerage account. Number 4, the only logical reason to buy a permanent policy for a child is to lock in insurability for a child with a health condition or family history. Number 5, for healthy children, a small-term policy is cheaper and sufficient to cover funeral costs. Number 6, in the UK, use a junior ISA. In Canada, use an ERISPEP. Those are better savings vehicles. Number 7, never let a child's life insurance policy interfere with your own retirement savings or emergency fund. Your financial health comes first. Number 8, the decision is personal. Weigh the emotional peace of mind against the lost investment returns. Only you can decide. Here is what I want you to do right now. If you are considering life insurance for your child, calculate how much you would spend in premiums over the next 10 years. Then open a 529 plan or a brokerage account and set up an automatic transfer for that same amount. Watch it grow. Then decide if the peace of mind is worth the cost. And if you already have a policy, review it. Is it term or whole? Is the premium affordable? Are you meeting your own financial goals first? Adjust if needed. If this video helped you balance emotion and logic, hit the like button. It helps more parents make informed decisions. Subscribe and turn on notifications so you do not miss my next video, which is called the one insurance product every parent actually needs. And comment below, do you have life insurance on your children? Why or why not? Share your story. I read every comment. Thanks for watching. Now go hug your kids and make smart financial choices. See you in the next one.